Now, in 48 hours, the Fed blackout begins. What does that mean? No Federal Reserve member will be allowed to speak publicly ahead of this all-important meeting. But here in a Fox Business exclusive, in what will be his only interview ahead of that two-day meeting that starts on the 30th, is one of the deciders. We're joined by the #2 man at the Federal Reserve, Vice Chair Richard Clarida, who will be a voting member. He always is, right, as a vice chair during that meeting. Welcome, sir.
Liz, great to be here.
Well, we're thrilled to have you here. So much going on.
Yeah.
And your compatriot, John Williams, just making some news right now. What do you make of his comments?
Well, let's talk about where we are right now. And the U.S. economy is in a good place. We have a solid growth rate. We have a strong labor market. You know, inflation is stable, but uncertainties about that outlook have increased, and we've talked about that. The global economy's slowing. Business investment has been soft. There are disinflationary headwinds abroad, and these uncertainties are something that we talked about in our June meeting. We'll talk about them again in July. And what we've said, Liz, is that we will act as appropriate to make sure we're doing what we can to sustain a strong economy and stable inflation near our target.
I am going to try and break you away from the act as appropriate. Because I want more detail. You know, 4 weeks ago, after that June meeting, you publicly said that the case for the Fed to step in and provide, you know, accommodation or rate cuts, as it is, had increased.
Yes.
Today, sitting here now, 4 weeks later, has that case been strengthened or weakened?
I think, from my perspective, Liz, the reality is that the economy's in a good place. We want to keep it there. We've had mixed data, but I do think, to me, the global data has been disappointing on the downside. Disinflationary pressures, if anything, I think are more intense than I thought 6 weeks ago. On the other hand, we had a strong labor market report, so that's great. So there's a range of data that we get, and we'll be talking about that at our July meeting.
You just said disinflationary situations, right?
Yeah.
Forces.
Yeah.
I want to get to inflation in a minute, but stick with the United States specifically right now.
Right.
What do you see that concerns you here?
Well, what I see is that inflation data has been coming in on the soft side. We would like inflation to be 2% and to be symmetric around that 2%, and it's been running a little bit short of that. The headline GDP number was very strong in Q1. That's great, but the underlying detail was a little bit soft. Again, we had some weak investment numbers in there. There was an inventory piece. So again, nothing of great concern, but I do want to indicate that, you know, we're looking at the whole picture and we want to put in place the right policies.
Well, I know the whole picture includes the rest of the globe. But you just mentioned some of the data that look worrisome. You know, the Philly Federal Reserve Index came out. That's an indication of manufacturing in the mid-Atlantic area. It was 4 times better than the expected number. We had a great June jobs number of, what, 224,000 jobs. The Beige Book yesterday was pretty positive. You know, I'm just wondering, how do you look in the mirror, you collectively, the Fed, and say, oh, we've got to cut rates? I mean, aren't those supposed to be reserved for emergency times?
Well, Liz, there are a couple of points here. First of all, monetary policy does operate with a lag. And so at each of our meetings, we need to make a decision based upon where we think the economy may be heading, and importantly, where the risk to the economy are lined up. You know, under ideal monetary policy, you adjust rates to keep the economy on an even keel. And so you don't necessarily want to wait, as I think your quote from John Williams indicated. You don't want to wait till the data turns decisively if you can afford to. To your second question, or second part of your question, Liz, you know, the reality is that in the past, the Fed and other central banks have found it appropriate to take out insurance policies in good times, and so that's part of the toolkit. If you need to use it, you don't need to wait until things get so bad to have a dramatic series of rate cuts.
But you've got a dual mandate of full employment, which we have, and inflation at 2% in the target. Yes, we've been stubbornly below that persistently, but do you see it trending even further away from 2%? Do you see a trend at all there?
Liz, a great point. Our baseline view is for our preferred measure of inflation, the PCE index, the core part of that, to move up towards 2. It's currently running at about 1.5, 1.6.
Right, but is it moving away?
Well, it has been moving away this year, and we think some of that is transitory. That's our baseline view. But an important part of monetary policy, Liz, is not only setting policy for the baseline, but also doing risk management considerations. And that'll be another consideration we'll talk about in July.
Do you see, you mentioned disinflation, which is the slowing down of inflation, right? Do Do you see a deflationary spiral at all?
No, not at all. No. And I think the fact is that under Fed leadership, really going back a decade, the U.S. was able to avoid that risk that, quite frankly, is a problem in Japan, and inflation is too low in the Eurozone compared to where they want it. So no, that's not an issue for us because we've had good monetary policy.
Globally, you're seeing worrisome signs, and what we hear from Chairman Powell is that's what he's looking at. But does that mean that we've now become the world's central bank?
Well, I think for decades, the Fed has in effect been the leader among the world's central banks. The dollar is the global reserve currency, and for a variety of reasons, I think that's been true for some time. What is the case now, Liz, and it is important for your viewers to notice this, is what's somewhat unusual about the current situation is the divergence between where we are in the U.S. cycle and where Europe and Japan are. So the Fed has been normalizing policy. We've moved rates well above zero. Look at the Eurozone. They have negative rates. More than half of European bonds trade at negative rates. Japan has got negative rates and is basically mired at lower rates.
And we've seen shrinking GDP in South Korea, and we've seen it in Mexico. So I get all of that. I get that we don't want to be standing there in the middle of the road in our, Escalade and then suddenly get barreled over by these trucks on our screen right now, which are seeing shrinking GDP. Yet a lot of people, smart people, have said that we've been in artificially low rates for too long and that has added so much debt to the American balance sheet. If we cut rates again or do some type of stimulus in some other way, shape or form, aren't we risking even more debt?
Well, let's talk about the debt picture. In the case of the U.S. economy, the household sector has actually been deleveraging for the last decade. You are correct. The corporate sector has added debt, and we discussed that in our financial stability report released a couple of months ago. But I think an important fact of life, Liz, is in the global economy now we have an integrated global capital market, and rates are low globally, and that's basically a fact of life for central banks. U.S. rates can divert to some extent from global rates, but there's a limit to how far that process can go because of integrated capital markets.
Is there a chance, come July 30th, 31st, the two-day meeting, that the Fed decides to leave rates unchanged?
Well, I think we go into every meeting looking at the range of options available to us. I think our messaging has been quite clear that we want to put in place the appropriate policies to keep the economy in a good place, and certainly we've indicated, as Chair Powell himself indicated in his press conference after the June statement, many members of the committee expressed the view that the case for providing accommodation has increased in recent months, and so that's certainly a factor that we'll be considering going into this meeting.
How do you view rate cuts through the lens of the protracted trade battles that we're in right now?
Sure. Well, Liz, our focus is the U.S. economy. We don't do trade and play policy. We stay in our lane. We stay in our lane.
You're bringing it in globally quite often in the first 9 minutes of this interview, so it does play in when you see slowdowns.
And the way that we think about that is, in particular, uncertainty about trade policy is elevated. There are different measures of that. And to some extent, uncertainty about trade policy is probably a factor that is impacting confidence in business sentiment and perhaps investment. And so trade policy and all policies factor into our outlook depending upon the way they shape our outlook for the economy.
Well, President Trump has very publicly put pressure on Chairman Jay Powell of the Federal Reserve. I know you're going to say the Fed is independent, but you can't ignore the chorus, and it's a loud one sometimes. How do you tune it out, and will you continue to tune out even when the commander-in-chief says cut rates, which is kind of ironic because he criticized President Obama's term for keeping rates way too low for too long?
Liz, I've been at the Fed now for 10 months. This will be my 8th meeting, and what I can tell you, and the transcripts when they're released in 5 years will bear this out, we're just focused on doing our job. We have a dual mandate assigned to us by the Congress. People can and do express opinions, and we're certainly aware of that. We have a very strong committee now of 17 individuals, and we're just going to make decisions that are in the best interest of achieving our mandate.
One last question.
Sure.
There are 9 quarter-point rate cuts left before we hit zero rates.
Yeah.
Is it really smart to use those arrows up when we only have 9 of them in our quiver at the moment? 1, 2, or 3 for the rest of 2019, as the Fed has indicated it will?
Well, again, I think that those are very important issues. It's a good question to raise. It's certainly things that we'll consider. I think it's also important to note that research has indicated that when you're close to zero, it's also relevant to think about acting preemptively when you can, if you can avoid a more significant downturn later on.
So we don't want less than zero.
Well, no, the U.S. certainly in the last financial crisis made the decision not to push rates into negative territory, and that's certainly not something that's come up in my time, in my 10 months at the Fed.
Good to see you, sir. Thank you so
Liz.
much. On a very busy day.
Yes.
You come in, it's boiling in D.C., and it's hot in the studio because we got a lot of news we just heard from you. Thank you so much.
Thank you, Liz.
Richard Clarida is the #2 at the Fed, Vice Chairman of the Federal Reserve.